Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in corporate filings. And today we've got a report that might make some municipal bond investors reconsider their portfolios. This filing is a look at something called a Form 8K, which is basically a report that companies have to file when some really important stuff happens that could affect their shareholders. Think of it like a company S way of saying, hey, something big just changed. So what is the big news from PIMCO New York Municipal Income Fund II? Well, they've decided to tweak how they invest your money, and it is a shift worth paying attention to. This report is dated the 19th of September 2025, and it tells us about a decision made by the Fund S Board of Trustees on the 17th of September 2025. This document is all about PIMCO New York Municipal Income Fund II, which you can find under Commission File number 811 to 21,078. It is a fund that focuses on municipal bonds that are often tax exempt. These guys have their common shares trading right here on the New York Stock Exchange under the ticker symbol 9I. Now, let's get to the heart of the matter. The big change here, as reported under other events, is a shift in their investment strategy. The Board of Trustees for the PIMCO New York Municipal Income Fund II made a decision on the 17th of September 2025 to change one of their investment guidelines. This is a fundamental change, meaning it is not a core rule they can break, but it is still a significant adjustment. What they're redoing is lowering the requirement for how much of the fund money must be invested in New York municipal bonds. Before, they had to invest at least 90% of their assets in these specific bonds. Now, they're rechanging that to at least 80%. This change will officially kick in on the 20th of October 2025. So after that date, under normal conditions, the fund will aim to put at least 80% of its net assets into municipal bonds that offer tax-exempt interest for New York State and New York City taxpayers. They call these New York municipal bonds. It is important to note that they are still committed to their fundamental policy, which says they will invest at least 80% of their assets in things that are exempt from federal and New York State income taxes. This new change specifically targets the portion dedicated to New York City and New York State tax exempt bonds. So, while they are giving themselves a little more flexibility with the New York specific bonds, they are sticking to the broader goal of investing in tax advantaged municipal bonds that benefit both federal and state taxpayers. This means they can now invest up to 20% of their assets in other types of investments, or potentially in municipal bonds that are only exempt from federal taxes, or maybe even bonds in other states if they see better opportunities. U1T see this change reflected in their official shareholder reports until their annual report for the period ending the 31st of December 2025. So while the change is happening soon, the detailed accounting of it will come later. The document is signed by Ryan G. Leshaw, who serves as Secretary and Chief Legal Officer for the fund. So what does this 10% shift really mean for investors in the PIMCO New York Municipal Income Fund II? On one hand, reducing the minimum investment guideline from 90 to 80% for New York municipal bonds gives the fund manager more flexibility. This could be seen as a positive thing. It allows them to potentially seek out better investment opportunities elsewhere or to adjust their holdings if the market for New York municipal bonds becomes less attractive. For instance, if there are fewer high-quality New York municipal bonds available, or if the yields aren't competitive, having that extra 10% wiggle room can be very useful. However, it also means there is a greater possibility that a larger portion of your investment might not be in those specific New York tax exempt bonds for investors who are heavily reliant on the tax benefits from New York State and city income taxes. This could be a point of consideration. While the fund still has a strong commitment to investing in tax-exempt bonds overall, the exact allocation to those New York-specific ones is now less stringent. It is like having a restaurant that used to focus 90% on Italian food and now shifts to 80% Italian and 20% other European cuisines. You are still getting plenty of Italian, but the variety has increased, which could be good or bad depending on whether you preferred the strict Italian focus. Looking at the overall strategy, PIMCO is known for its expertise in fixed income, and this minor adjustment likely reflects their ongoing effort to optimize returns within the municipal bond space. They are still aiming for tax-exempt income, which is a key benefit for many investors, especially those in higher tax brackets. The decision to lower the minimum suggests they might be anticipating changes in the municipal bond market, perhaps a tightening of supply for New York, specific bonds, or simply identifying more attractive opportunities in other tax-advantaged sectors. From a broader economic perspective, changes like this can sometimes signal a company's outlook on specific markets or asset classes. By giving themselves more room, PIMCO might be signaling a belief that other types of municipal bonds or even other investment vehicles could offer better risk-adjusted returns in the near future. It is a way to adapt to market conditions and ensure they are maximizing value for their investors, even if it means a slight deviation from a more concentrated strategy. Ultimately, for the average investor, this change is subtle but important. It means the fund has a bit more freedom to navigate the bond markets. The key takeaway is that the fund is still focused on tax-advantaged investments, but with a touch more flexibility than before. If you are an investor in this fund, it is always a good idea to stay informed about their specific holdings and strategies, as even small shifts can have an impact on your overall portfolio performance and tax situation. So, what is your take on this Fund S strategy adjustment? Does a bit more flexibility in investment strategy make you feel more or less secure in a fund like this? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more insights into the world of finance and business. Don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and I'll see you in the next video.